Hello. This is the second lecture in the section entitled Financial Markets Risk, Asset Class, and Fusion Analysis. So let us begin with how do you evaluate equities? And we're looking at these from the buyer's perspective as opposed to the firm's. And there's honestly many different ways and approaches. Each one has its merits. And some of them have some strengths and weaknesses. And it's about with anything. There's different approaches. There's no one way. When we get into financial analysis, there's not one way. There's many different views and interpretations of data. We see data and we see different things in them. Also comes down to the individual that they have different objectives and see things differently. We all have a point of view based on our education, our experiences, which include where we have traveled, what we have read, what we have learned, things that have worked, things that haven't. So what I would like to share with you is my approach, and it's based off of this book, Fusion Analysis. And what it does is it sort of takes a look at some of the big strategies that are used and tries to pull them all together. We have a macro approach, we have a fundamental, we have a technical analysis approach, and then we have a quantitative approach. So what I've sort of done in my view of analyzing equities is to use all of them together. They fit together. I take what I think is good about some, and that can offset some of the disadvantages. Macro analysis is just that. It's broad. It starts at the very top. So you develop a thesis of the market overall. Are they going to go up? Are they going to go down? Or are they going to trade sideways as they have been? It incorporates your view of the economy, growth, politics, based on the different forecasts and reports that we see. Actions of investors. If a large number of investors believe the nation is going to enter a recession, their actions can affect the direction of the market. We're seeing that today. Almost a third of economists are predicting a recession for the last half of 19 and into 20. And some of that's been played out in the markets in the past few months, since probably October, that people are now fearful of a recession. How that is caused is open to discussion, but it's becoming a more prevalent thought that we will go into a recession. At the same time, you could look at employment, inflation, inventory, consumer spending. And if we look at them, employment is good. We're at the lowest levels. Unemployment is good. Inflation seems to be under control. Despite that, generally when the labor market gets tight, inflation comes back. We haven't seen that. Inventories look good. Consumer spending, this was a great Christmas season by all accounts. Consumer confidence has been strong, but we haven't seen it reflected in the companies and stock prices. Government actions, decisions on interest rates, taxes, trade, policy, antitrust, budget impact, all does that. So what we're seeing is some views of the interest rate. The tax cut of last year gave us a sugar high. It's not going to lead to longer term growth, I think, is what people believe. Trade policy has upset the apple cart, so to speak, and really is causing a lot of negativity on that. The deficit spending that the U.S. has, and now the shutdown. What's happening in the global economy? This is a big thing, the global economy. The U.S. is trying to isolate itself from the world. But we're all connected, as you remember from our economic background. So you can take this macro analysis and determine how do they impact the firm. Impact on sales volume, price, and costs. So that's one approach, this macro approach. Well, I think it's important to know what's going on and have a view towards that. Then we move on to fundamentals. This is what we have been studying for the past couple of weeks. We're looking at actual results. Forecasts, not so much, as we're going to do that in financial statement analysis, but we study the 10K and other financial report. We look at ratios. We understand what's driving the company. We look at the PE ratio, the price to earnings. We look at it from a historical perspective, which is the prior year's earnings per share divided by market share price, and conversely, projected earnings, forward earnings. So you can't just look at historical, because the value of a company is based on what the future cash flow will be. That's often used. So that's what we've been studying, is fundamental analysis, and that's when your final project is really a fundamental report on the company. Critical point. But it has to be within the context of that it's a part of the overall analysis. Then there's technical analysis, which are charts and graphs which are statistically computed. They look for buy and sell opportunity. They come together, they diverge. The trend can be your friend. And again, what is a trend? How long is it? What period should be as a point of view? And trends do reverse. Now, this technical analysis can be done at a broad market level and then by individual company. Coming back to when we look at what causes variation in stock price, one, there's the macro environment, and number two is the performance of the company within that macro environment. So when we look at technical analysis, I tend to only look at a couple things. One is the 50 and 200-day moving average. And what we can find with that is an uptrend or a downtrend. And we can see different levels of support and resistance. Is that when oftentimes a stock hits a point it doesn't want to go over that's called resistance. Other times it has support that it doesn't drop below a certain point. But this is based on 50 and 200-day averages. It can be computed many ways. We'll actually take a look at a few screens in a moment. And then there is the average volume. You're looking at, is the volume consistent? Is it average? Because when you see all of a sudden a stock that has an average and all of a sudden the volumes are doubling and tripling, that can be a red flag. It can be a good one or a bad one. It could be that there's a lot of upward trend happening. People are excited in buying, or they're selling. So we want to look at it within that context. The last one that I like, and I think it's a one that's it's interesting. There's probably a few thousand of these if you come down to it. Relative Strength Index, RSI, and it's a momentum oscillator. An oscillator is something that moves. It measures the velocity and magnitude of price movements. Okay, and momentum, if we define it, is the rate of the rise or fall. Is it going fast or is it going slow? Okay, that's where you get this oscillation effect. It's on a scale of 0 to 100. 70 indicates that the stock is overbought. 30 would indicate that it's oversold. So these tell us how strong the price movement and the trend is within the time period, and whether it's a buy point or a sell point. When it's overbought, we may tend to wish to sell. When it's undersold, it may be a buying point. Now, to actually walk through some charts with you, explain some things so that you can get a better sense of what these technicals mean. It's very mathematical, statistically based. It's used to provide direction and give you insight into what's happening within a specific equity or within the markets as a whole. The first thing we see here is I put O'Reilly in, right here where I put the this in. This is, by the way, from TD Ameritrade, and you can get this in a practice trading mode. Just go online to TD Ameritrade, and you can download it. What you have is, the first thing is, these are the closing prices on that day. So if it's a green, if it closes up for the day, it's green. If it closes down for the day, it was red or down that day. So these are called candlesticks, and you can see that some days it's up, some days it's down. We're looking at a period right now of daily for 1 year. We can change that and look at other things. So the first thing is, this is what it has been closing, And what you can see, based on the dates, there tends to be certain patterns that we're seeing. So the first thing I did is I put a 50-day moving average in. That's this blue line. And what it does is it calculates the average of the 50-day moving average. And it recomputes itself every day. Then there's the 200-day moving average, which is the green line. So what you can see is that over the past year, it has a little pattern. It's gone up and down. But what you can see is a good portion of the past year, the closing prices have been above the 50-day average. So that is indicating a positive trend. Now, what we've seen in the financial markets overall is we've seen that this has been a very rough period of time. In the past year, the high was right here on 11/14 when it hit 363.2. The low was 217 when it hit on 4/20 of this year. So we've seen it. I mean, there's been a lot of movement. The trends have been going up. In this case, we still see the 50-day is still above the 200-day, but in the past month and a half, it's pretty much flattened out. So it goes below the 50-day, then it bounces back up, it's over it, and it's been seeming to hug right around that average as we're moving. Where it closed on Thursday was right at the 50-day moving average. So what we see is the different dates. The other thing that we see here, this 4.5, that is the earnings that happened on those days. So we can see what the impact of earnings have been, quarterly earnings, positive or negative. So that's this is the price chart and the simple moving averages. Right now, because of the market correction, we're actually seeing that some of these are coming down. Next thing we look at is volume, and this gives us, again, if it closes up, it's green. If it closes down, and I put a line in here, you can see the average. So generally what you want to take a look at when you're looking at that is what happens when it's above the average. What's going on? And what you can see right here is we had a big price bump, and if we look, we will see that that happened with earnings. So that green closing up on higher earnings on higher volume is good. Closing down on higher volume is not good. So we look at the relationship, and you can see this is pretty much average, other than a couple of spots here where you've been above, but generally the average has been, of the volumes, has been pretty flat. Next thing I want to talk about is the relative strength index. And this is, it's a momentum indicator. And what it is looking at is the next one I put in here is a relative strength index, RSI. And what this is, it's an oscillator. It's a picture of what's going on with momentum. It measures the velocity and magnitude of price movements. Which direction are they moving in? It's measured on a 0 to 100 basis, and 70, this line here, would indicate that the stock is overbought. If it's below 30, we'll see that it's oversold. So if you're really thinking about this, if it's an overbought situation, over 70, that might be a sale point for you. If it's below 30, it may be a buy point. Okay, so it's a momentum. It's the rate or the velocity of the rise or the fall. And we can see that it's been pretty much over the past year, but in what we'll call a normal range. It's a nice smooth slope. The velocity isn't too fast or too slow. So we have that. So again, just to highlight, I'll bring in, let's bring in Molson Coors and see what happened. Okay, now this is a very different chart. If we look over the past year, what you can see is that the 50-day has been trending down and is under the 200-day. So in a sense, what we're seeing is this is a downward trend. Okay, so just let's go back and take a look at O'Reilly, same period. We're seeing really a positive trend over the past year, and we still see that the 50-day is well above the 200-day. So we go back, let's put tap back in, is what you can see is it's on a downward trend. Volume, though, continues to be, it's trading a little bit over the average volume. But what we see here is it's been oversold numerous times, and it's in an oversold category right now. But see how the price dropped, okay, based on earnings. Earnings weren't met. Then we see it going up. We see patterns and things, but that's another class. So let's take a look at STLD, which is the other company we've been following. And again, you can see that up until this September that it was 50-day, the closing prices were above the 50-day. And since we've gotten to about 921, we've seen a dramatic sell-off. And if we look, it is indicating that it's an oversold condition. And we have a lot more, the volume is much higher, but what we can also see is it's trading above its average line. So let's just recap. What should you know about charts? One, this is called a candlestick, and days that it closes up over the previous close is green. If it's red, what it's telling us is that it closed down compared to the previous close. We have a 50-day trend, which is the blue, 200-day. We'd like to see them go up, heading up from a trend. And I think the best one of that, of the ones we've looked at, have been O'Reilly. If we look, generally that trend is a positive trend, and that's what you want to really see. We then look at volume, and these are number of shares traded every day. And you can have a 50-day line. I put a 50-day moving average in. But we can see how is it trading relative to its average. So is it moving consistently, or is there more volume? And is there more volume as the price is going up or going down? The last thing is the relative strength index. It's a momentum oscillator, and momentum is the rate of rise or fall. So we look at 70, anything over 70 means that it is overbought. Under 30 means it is oversold. Okay, so that's just an idea of what some of the charts are. And there's, if we look, there's so many different studies we could add in. If we wanted to add a study, there's all of these different studies, patterns we could put in, and we could draw lines. We could do all sorts of other things. So one of the things, let's just put in here, I'm going to put in here, is we can actually change the time framework. Is I could do a time interval of 3 years, and let's do that weekly for O'Reilly. And again, we see how it's behaved over the, if we go all the way back here, $232, we've gone back to 114.16. So we can see over time it slowed down a lot right here, and then it's coming right back up. And we can see that if we're looking at a short-term basis, you can see that it has a positive slope. So some of it depends on what time period. A lot of times, and again, this reflects individual stocks. If we start to, let's just change this back here. Do a time framework, year to date, 1 year. Let's do that because we have that in here. This is the year to date, so that starts in January and it runs through here. So you still see where this is a positive trend, although it's beginning. It's on the lower end of it. It almost is oversold. Now let's see. So that gives you a brief sense of what charts look like. And I use them as part of my overall analysis. There's technical traders who trade just based on this, but I think it's important to look at all different aspects as you have seen. So hopefully this is helpful. If you have any questions, please let me know. We're more than happy to get into a more in-depth discussion if that's interests you. Now that we took a look at that, I want to bring it back to the whole market. And this is just as I'm doing this as of 12/28. and we never know by the time you get to it in the next couple of weeks. The market has moved a lot. But what this chart is the S&P 500, which you know what it is, and what the red indicates is relative strength. So if we put in relative strength and show that it's overbought, the red is overbought, the green is oversold, okay? This dark blue is the actual closing point of the S&P, and this line here is the 50-day average. So what we can see is right at this point, the market is well oversold. And it's almost, at this point, it's 2 standard deviations away from the 50-day moving average, which is really unusual. You generally are looking for it to stay within that 1 standard deviation. But it's got a long way to come back up. But when we look at it where it started last year, we were clearly, as we ran into early January, early February, we clearly were in that overbought market. It responded, and we held down here in the oversold for about a month and went back up, and we're clearly oversold, overbought, and boom, it happened. So we look at that, and this is an example of what the relative strength is telling us. And when we look at it by sector, we don't see any of the sectors that have are any different. Everything looks pretty much the same. Everything's in an oversold category based on the statistical measurement. It's statistics. It doesn't interpret data. It just it looks at it from a historical and a mathematical perspective. Okay, so now let's move on to quantitative analysis. And it can be done for a number of reasons. It's measurement, performance evaluation, valuation. It's often used to predict real-world events that may impact the shares. It's very complex mathematical and statistical modeling, measurement, and research. They assign a numerical value to variables, and they try to replicate what might happen mathematically. And there has some strength in that, and there's a lot of quantitative system-driven trading algorithms that exist. It's a powerful tool, but I don't think it tells you a complete story without the help of its opposite, which is qualitative analysis. Is what we have been doing in this course has been a qualitative approach. In financial circles, they're referred to as quants, quant jockeys, or rocket scientists, just for fun and kicks. So those are the different pieces that go into how I approach analysis. That is just another way of doing it. As I said, there's multiple ways, but I wanted to introduce you to some of the key ways of how do you evaluate an equity. If you have any questions, please let me know. And this material will be covered on our final quiz. So make sure you look at the key points and understand what they are. If you have questions, do let me know. Thanks.